was interested in the indicators that you talked a little bit about toward the end of the paper, the dealer gamma and the basis between an ETF, an index ETF, and an index mutual fund. So first of all, what are these about, or what are you trying to track here fundamentally? And how are you contemplating, or how should investors maybe contemplate using these to inform tactical tilts between the sleeves?
Yeah, so this is a question of how can we try to identify market stress, or how can we try to forecast market stress? And so as we started thinking about it, obviously, as I've said, I'm trying not to give ideas as where my high conviction ideas are. I definitely have more conviction in the influence of options, for sure, at least in this current market environment. And so going through and trying to estimate how dealers are at large positioned, I think is going to be very important for understanding, well, is the low volatility we're seeing today a function of general market malaise? Is it a function of positive economic expectancy, or is this purely a reflexive function of dealer positioning? And I think that sort of puts you on a different setting of, okay, if we're seeing huge negative influence or repressive influence by dealers, and we know that's going to be driving up vol in all these volatility contingent strategies, making that left tail more and more and more fragile, you have to think about, I can't sit out for the melt up, but man, I really want to make sure I probably have some of that protection on, that convex protection, as cheaply and as explosively as I can find it, because I do know that the longer this goes on, the more violent the unwind is going to be. And so all that dealer gamma or that hedging pressure that we're looking at there is really looking at the open interest at any time in S&P 500 index options, and making the broad assumption that all calls are sold by individuals and bought by dealers, and all puts are bought by individuals and sold by dealers, and netting out where they are at any given time, what the implied hedging pressure is, and aggregating that all up together. Now, is that a perfectly accurate picture? Absolutely not. There's a lot of people who will go through the very painstaking work of going trade by trade with the options and trying to figure out who crossed the bid, who crossed the ask, who was likely on the other side, and that can paint you a more accurate picture. But I do think in broad strokes, this does give you sort of a good idea as to the hedging influence that these dealers are going to have at any given time.
Any idea, have you tried to use this time series as a feature for forecasting purposes?
So you can definitely, yep. So we've definitely started to try to introduce it for some tactical views. I think what you find, interestingly enough, is you don't know how long some of these regimes are going to last for, right? So you can start to think about, as I mentioned in March, there were the early indications of, wow, it really looks like things are about to get volatile. But volatile doesn't always necessarily mean things are going to sell off. So September 2011, I think, is a great example where markets sold off rapidly. If we go back and look at dealer hedging pressure, the sign flips. But as I said, all that means is now dealers go from suppressive behavior to expanding behavior. As markets go down, they're going to sell more. As markets go up, they're going to buy more. So that doesn't necessarily mean it's going to drive markets down unless you have all these other players at the same time making for the exits. You have to have market makers being limited in the type of liquidity they can provide. You have to have all these players being limited in the type of liquidity they can provide. And so I think to a lot of the conversations you and I have had, it's not just a one variable, one input type tactical signal. There's a lot of conditionality to it.
Yep, makes sense. And then I really like this idea of measuring the basis between the ETF NAV and or not ETF NAV, the ETF price and the mutual fund price, right? So how did you get this data, and what is this chart saying?
Yeah, so all this is really showing is the return differential between an ETF and a mutual fund that theoretically track the exact same investment, right? If they're both tracking the S&P 500, you would expect very little dispersion, because any dispersion there can be pretty easily arbed away by buying the mutual fund and selling the ETF. Interestingly enough, in doing so, you probably create a larger dispersion here, because very often what you see is that it's the ETF price that ends up going below the mutual fund. So you actually end up blowing that out further. But I think what it's showing is the stressed environment in which the market is going under. That when you have two securities that are theoretically linked to the exact same basket, trading in a materially different price, it means the underlying basket and the arbitrage mechanisms that keep them in line have fallen apart to a certain degree. And it doesn't necessarily mean that they've fallen apart and that there's no one there. It just means that the people who are usually taking part in this arbitrage are either liquidity constrained, or they're operating with a degree of hesitancy, in the sense they're going, we don't understand what's going on. There isn't enough of enough juice here to justify us taking this risk. And so you see this certainly in equities. In fixed income, this exploded tremendously during March. I think I have a graph here where I show the difference between the Vanguard total bond fund and the ETF share class of that fund, right? So this isn't even, we're looking at different vehicles. We're talking about truly different share classes of the same fund having huge dispersion in their returns. And I think that's just an example of some of the arbitrage bounds that normally keep the whole market in line breaking down.
Yeah, this is a function of Virtu not being able to raise the $400 million that they would love to deploy in order to arbitrage the spread, right? I mean,
right, and just the bond markets in particular. Yeah, the bond markets in March in particular just breaking down. And look, I think there's interesting trades here to think about. There's huge, I think, embedded optionality, as it turns out, in owning fixed income mutual funds by the way pricing occurs, that you can buy the mutual fund and wait for a crisis and then just jump to the equivalent ETF. And either the ETF will converge back up to the fund, or the fund will converge down to the ETF. But either way, you've sort of missed that price jump. And it's really at the cost of all the investors who have stayed in the fund. So when we think about, I don't want to say we're taking advantage of well-trained Vanguard investors, but you see that during a market crisis, Vanguard investors tend to just keep staying in their fund and they don't tend to withdraw money. Well, if you can buy the Vanguard total market fund, bond fund, and then just wait for a crisis, jump to the equivalent ETF. In this case, if you'd done the right timing, you're talking about a pretty healthy spread of total return there.
Especially as a percentage of total expected bond returns.
Exactly. Now, again, this trade is not it's not riskless per se, but the optionality is being sold to you by all the people who are just staying in the fund. And I don't think they're being compensated for it.
Yeah, 100%, 100%. So are you building any, like, how's Newfound positioning for this from a business standpoint?
Yeah, so this obviously has, I think, pretty big implications, again, depending upon your conviction on how you think this is unfolding. So Newfound has, for a very long time, been a trend following focused firm. And if you believe that there's going to be more of these liquidity cascades, then the efficacy of trend following has to be called into question. And you can argue, well, all you need to do is speed things up, but that's not without its own costs. And it's also just sort of becomes an arms race. If everyone speeds things up, it just sort of makes this all unfold quicker. The other option is, well, you slow things way down. And then the answer is it's March 2020, the market's fallen off 35%. And you're sitting there saying to clients, don't worry, it's going to come back. It's a liquidity cascade. It becomes just an impossible ask from a client servicing perspective. So for us, where we have conviction, high conviction in some of these ideas, we are starting to adopt and implement some of them. We are, in some of our mandates, reducing the exposure to explicit trend following and introducing both some types of convex hedges, both on the right tail and the left tail, as well as trying to introduce some liquidity-based tactical signals that can inform some of the convexity we're introducing, as well as try to inform which regime we're leaning into at any given time.
Nice. Well, hopefully you're going to publish some articles that describe some of the ways that you're using these indicators tactically in a systematic way.
Well, I will tell you that this article almost killed me. getting this out the door. So I'm going to take a healthy rest, and then maybe we'll get back to it.
I hear, you should go travel the Caribbean. I think that'd be a really
I hear that's pretty nice.
We'd love to obviously see you down here, so you're welcome anytime. But well, this has been fantastic. I mean, this paper. I think we covered a lot of the concepts, but there's still lots in there that we didn't get a chance to cover. So you should absolutely go and read it top to bottom. I agree. Some of Ben Efert's recent tweet storms have been incredibly informative in terms of the types of leverage that even small retail players can get from their option positioning in individual names, and the impact that can have on just the trading pressure and some of the giant moves that we're seeing in some of the big tech stocks, for example, at the moment. Other conversations with Mike Green and others in this sort of ecosystem have been enormously informative. So definitely go and check those out. But I think this paper is a really good summary. Like I said, it's sort of, you triangulate the views from at least 3 sort of specialist areas to try to narrow down the trajectory of what to expect from, or what one might expect from what's happening and how the markets have adapted. So it was awesome, and it's a lot of fun, the conversation. So thanks for your time.
Thank you, sir. I appreciate the opportunity.